The second half of 2026 is likely to be a more range-bound market, at least until there is a clearer visibility on earnings recovery. In this environment, our focus will be on stock selection to generate alpha. On the brighter side, there are 4 macro and market developments that taken together reinforce a positive stance of the Hong Kong and China equity markets in the second half of 2026. First, geopolitical developments in the Middle East may have some indirect positive effect on Chinese mainland. While Chinese mainland is a net oil importer, oil accounts for a relatively small share of its energy mix. The rising contribution of renewables helps reduce vulnerability to oil shocks. We are also seeing the strength of its manufacturing ecosystem, with industrial companies in Chinese mainland receiving stronger export orders. Secondly, increased investment in industrial capacity and AI is a major positive. Leading industrial firms in Chinese mainland are expanding globally through overseas investments in markets such as Thailand, Vietnam, and Mexico. At the same time, increased investment in industrial capacity and AI is supporting long-term growth. Thirdly, Sino-US trade dynamics have shown signs of relative stability, reducing a key source of uncertainty. Finally, a stronger renminbi against the US dollar year-to-date has improved the attractiveness of renminbi assets. This has also supported an active Hong Kong IPO market, particularly for the China A-share companies seeking dual listing in Hong Kong with attractive valuations. In terms of risk, we remain cautious on the Chinese mainland domestic consumption as it depends heavily on the retail sales trend. Year-to-date retail sales remain weak, which continues to weigh on the outlook. That said, heading into second half of 2026, we believe the worst of earnings cycle may have already passed. Large companies are increasingly prioritizing investment in AI, which should help support future growth. As a result, we expect earnings in the second half of 2026 to be broadly acceptable. Manulife Dragon Growth Fund invests across China and Hong Kong equities using a growth at a reasonable price approach, focusing on companies with strong growth potential and attractive valuations. The fund is positioned in key structural growth areas, including the Chinese mainland AI technology and supply chain, such as data centers, semiconductors, and robotics, as well as advanced manufacturing like battery and power equipment. To capture this trend, the fund maintains an overweight in information technology and industrials. This approach has delivered results, with the fund ranking in the first quartile year-to-date and over 1 year in the Morningstar Hong Kong equity category.